Well, hello everybody and welcome to Trending Treasury, the webcast series from Arling Close. We're back after a brief break over the summer where we did our summer short series, and now we're into the swing of things, and we're starting with the, I think, quite important subject of local authority debt funding. This week, I'm joined by David Blake, who's a Strategic Director at Arling Close, who will be going through with us some things about the local authority debt landscape, where we expect things to go over the next few months and beyond, and also what realistic options are there for local authorities who are looking to take on long-term debt. David, can you hear me loud and clear?
I can, Stephen. Can you hear me?
I can indeed, which is excellent. How are you finding being back after everybody's summer breaks? This is my first full day back, so a bit of a shock to the system perhaps, but for me, I'm raring to go. How about you?
Oh, I'm good, mate. I'm good. I'm fully charged, ready for action. It's quite quiet over the summer. Had a couple of good staycations, but yeah, ready to get back into the swing of things. I think it's going to be an interesting year. So yeah, plenty going on. Brilliant.
Well, let's get. I can see we've got. I think everybody's arrived on the webcast that we're expecting. So let's crack on. Just thinking about where we are now. What does sort of the local authority debt landscape look like? What's the scene at the moment as we all come back off our summer holidays and sort of get back to our desks in the first week of September? What does it look like from the local authority treasury officer's desk?
Sure. Well, I think it's everyone's waiting for the Public Works Loan Board. To be frank, we're clearly expecting a decent reduction in the margin from HM Treasury. They've closed the consultation, and that's going to be hugely significant for funding costs. So we've had a very quiet summer months in terms of borrowing levels and PWLB borrowing, but we have started to see some looking at the alternatives. We've seen some interesting bond issues. We've seen some product development from the banks, more interest from pension funds, insurance funds on private placements. So there is that background activity, but in terms of funding, I think most have been quiet. And of course, we've seen quite a large liquidity injection to the sector from the grant payments from central government. So we've actually got investment balances at all-time highs across local authorities at the moment.
So that's quite interesting, because you might think with long-term rates so low, and they've been obviously low for a long time, but coming down, you might expect a glut of deals, but it's a bit more that people are waiting to see what the outcome of the Public Works Loan Board consultation is. I mean, so how are locals managing their short-term book in that case? I mean, if we look at locals, obviously maybe pausing their long-term debt decisions, but you'd hope that they're not pausing their capital program. So how are they going about their sort of short-term book, and how's that interacting with those record investments that you were talking about?
Yeah, I think we've got a lot have been relying on shorter-term funding, but of course, as we said, liquidity, cash levels are generally higher at this time of year for local authorities, and we've still got this reluctance to carry too much cash at the moment, and one we would support. You've got to find a home for it, and we're still seeing elevated levels of risk across the economy. We may be past the worst perhaps in terms of the pandemic, but clearly we've got several sectors of the economy struggling, and we are keeping a close eye on loan defaults, etc. So against that credit backdrop, we do see a reluctance to lend out, and we've got some investment levels that are turning negative as well. So that sort of sets the scene for funding. If you don't need to fund and you think there's going to be a big reduction in rates coming down the track fairly soon, then sit on your hands and take it easy, as long as you're not running out of cash. And thanks for putting up this slide. We can see we've got March end figures for UK local authority investment balances. We've also got the June end figures as well. And you can see that, yes, there has been an increase in cash balances. I would dare to say that between the two, between the March 20 and the June 20 figures, perhaps we did see a dip while we were waiting for those grant payments. But there's been a substantial amount of grant payments made to local authorities. And yes, of course, there's been a lot of money out the door to businesses as well. But you know, that's the aggregate figure we can see there for June. We can see the red bars at the bottom, the local to local investment balances down slightly. The grey shaded area are money market funds, so we can see that locals are tending to invest their money in more liquid assets, ready to deploy them perhaps, and also a tick up in the DMA DF as well, perhaps a preference for quality at the moment. But you know, the fact is there we've got a lot of authorities with a lot of cash, and that's allowing them to hold off on long-term funding decisions at the moment and recycle that through the system between their peers, which we know from discussions with HM Treasury is something they want to encourage. They want to obviously make sure that locals remain liquid and there's enough cash there. But of course there is the PWLB for those that need it. But we've just had the August figures out for Public Works Loan Board, and once again, very quiet month, just over 100 million, I think, and most of that, lion's share of it, 84 million or thereabouts, was Transport for London. So other local authorities just sitting on their hands.
Yeah, it's interesting you say, you know, there was that little downtick between March 20 and June 20, but actually looking at those figures, the June 20 figures for local to local deals is still higher than March 19. So even though there might be a little bit of movement between March and June, actually the sector as a whole is still bigger than it was, you know, last year. It seems like the market's relatively healthy to me, or am I taking things a bit too simplistically?
No, I think you're spot on, Stephen. It is healthy. It's an incredibly cheap way to fund, and there's a plentiful supply, and of course locals know about the credit strengths of local authorities, the framework that underpins the sector, and are generally happy making deposits across all local authorities. You know, it's broadly consistent with our advice. So not surprised that you know, the trend is up, even if we're down slightly on the March figures. I expect it to continue to grow, to be frank. You know, we've got some money market funds that are paying 0% now, and we have positive returns still across local authorities. So I think that is going to suck more funding out of perhaps money market funds, bank deposits, maybe the DMA DF as well, and we're going to see that local to local sector grow. But you know, it's still plenty of capacity based on these numbers for local to local funding, although we may see blips and we may see sort of brief periods where there is a preference to hold liquidity, and you know, perhaps we see the rates become more expensive again. But it's still, you know, even if you have to pay over the odds towards the end of the financial year for a few weeks or months, it's still much better than paying 180 or 1.8% away to the Treasury margin.
Yeah, it's interesting, isn't it? If you think about all of these sort of super safe assets, as we might think of them, or safe liquidity movements. You know, rates are in the floor, but local authority rates, I mean, obviously they're low, but they haven't gone zero or negative up to now. I mean, putting you on the spot a bit, do you think that there might be that? Do you think that's a lag, or do you think that's just a sign of the market, of the fact that local authority borrowers are willing to pay for the convenience, or you know, are willing to use the market and tap the market as a positive thing, and sort of the low administration costs and all of those things? Maybe perhaps willing to pay, and obviously, depending on how you go about it, low brokerage fees as well. That they're willing to perhaps pay more than zero just for all of those things, or do you think that actually there's a lag in the market and we might see rates drop further?
It's a good question. I think we could see zero rates and negative rates in the local to local market. I think at the moment, yes, you're probably right on a lag. You know, while money market funds have been paying a positive return, I think that does lift the rates in the local to local market to some extent and help them stay reasonably buoyant. But we've seen trades going through 2 basis points now, so we're very close to zero. And of course, real returns on local to local, investment returns have been in negative territory in real terms compared with inflation for quite some time. But I think that zero and actually getting that less than you put in is quite a large psychological barrier, and people start to question the logic and the security of their deposits if they're getting back less than they put in. But it's going to be a factor of the market. If rates are turning negative and the alternative options for cash are negative, then yes, we're going to see negative local to local. And actually run some tests on idle trades recently to make sure it could handle negative interest rates, and sort of pleased to say yes, it can. But yeah, we haven't seen that tested yet, but it may not be too long before we see that.
Great. Okay, so I mean, obviously we've covered the short-term liquidity piece now. I mean, what options are there out there now for clients who do want to look at maybe locking out some longer-term debt, or locking out some or sort of giving themselves a little bit of duration? Obviously, we've talked about the fact that clients are looking at maybe waiting for the Public Works Loan Board to come out with their response to consultation. But if you are looking to de-risk a little bit or add some duration now, what are the realistic options, and what are you likely to pay for them, I suppose, is the million-dollar question.
Yeah, good one. I think there's a really interesting space actually between the sort of super short local to local market, which is typically less than 1 year, although we are starting to see slightly longer duration deals in that space, and then your Public Works Loan Board, where people are taking the plunge. Often it's 10, 20, 30, 40, 50 years, long-term debt. But I think there's quite an interesting space in that perhaps 1 to 5 year period, which caters for authorities that perhaps have already started to build a short-term local authority funding portfolio, but perhaps got a bit jittery around March when funding was harder to come by and rates did shoot up, and are thinking about the administration related to that and the refinancing risk, and perhaps want to go a bit longer. And yes, you can get that with a local authority, but we don't see many authorities willing to invest at these levels and sort of place money out with another local at less than 1% for several years perhaps. So where does that funding come from? And I think that's where the banks can be useful. I think the banks have started to develop interesting products. Some are already available. We've already got some overdraft facilities that are quite competitive when compared to Public Works Loan Boards. So you're talking about rates, well, typically 1 to 2% over bank rates, but compared to 1.8% over gilts. There's quite a lot of value in that, and of course there's quite a lot of flexibility in that, and I think that's where the market's going to turn to flexibility, to say, well, hang on, when do I need funding? I don't need it all year. I might need it for in some periods towards the end of the month, or in some months more than others. Where can I get flexible funding that I can turn on and off? So perhaps we will see more use of overdraft facilities. We might see revolving credit facilities and those sorts of products we know are sort of becoming available for local authorities, and shorter duration debt and floating rate debt as well. So I think that's all going on in that medium term space. So we're working on a few interesting ideas and products there. And then of course there is the bond market and private placement and public bonds, and the slide we have on 3 I find super interesting, and then forgive me if you don't, but I guess most people tuning in have some interest in this. So we've got the PWLB certainty rates at 1.8%, and we've spoken about this before. The local infrastructure rate from the Public Works Loan Board at 0.6% above gilts, and then this space in between where we think, well, the market can offer alternatives to Public Works Loan Board, and we're seeing more and more benchmarks now, which is nice. We're seeing these dots fill up. We know the HRA rate is 80 basis points, but we've seen Lancashire issue 5-year bonds in that space at a similar level. So that's very encouraging, and this was via the bond agency. So we have that 2025-year issue, but we've also got that 2060-year issue that's just been launched as well. 100 basis points over gilts is a fantastic result for the bond agency and for Lancashire, and it smashes what they would have paid Public Works Loan Board. It's a significant saving there. 80 basis points over 40 years. We've calculated savings in excess of £40 million on that. It's, that shows what can be done, although it is hard to replicate. There's not so many who need to issue in such large size and have the credit rating and are ready to go in a single name issue along those lines. However, for those that want to look at that type of thing, there are other opportunities. The West Berks and the Warrington community bonds are interesting, much smaller, £1 million each, much shorter. 5 years is the final maturity, but the average duration is only 2.5 years, and they're paying 1.2% for those, which as a margin over gilts is probably about 1.2%, as the gilt yields are pretty flat in that area. But again, cheaper than Public Works Loan Board and gives them some certainty of funding. And to be frank, £1 million is neither here nor there for those authorities, but it does set a precedent. It sets a new route to market, and it does give them something to build on. And all these bonds and all these alternatives give HM Treasury food to thought. We know they look at this. We know they'll be thinking, right, when we set our new rates for those that are compliant and aren't doing debt for yield, where are we going to pitch this? We think they still want to make sure that most funding comes from the Public Works Loan Board, but they may want to not entirely squeeze out the market alternatives. So, we're still thinking, well, 80 to 100 basis points over gilt to be a logical place for the PWLB reduction to come in. But there's no guarantees on that, and there's no guarantees when that will happen. So, quite rightly, we're seeing authorities say, right, well, we're going to do our own thing. We're going to diversify our funding streams and look at some of these alternatives.
Yeah, it's really interesting about the whole size issue, because one of the reasons the MBA seems to have been put together was to get around the issue of some authorities not being able to issue in hundreds of millions of pounds. They want £5 million here or £10 million there. It seems we're not there yet with the MBA getting those club issues together. And what are some of the issues that they're having on getting that club issue out and allowing people to access the market funding as a group?
Yes, we speak to the bond agency. We are in contact with them. I think it's still the fact that you do have to have a look at who's in your club, who's in your group. And although you don't have to guarantee the entire bonds yourself, which was the problem with the joint and several, there is still a proportional guarantee. And if some of the members of that group do default on the obligation, there is some element of risk to that, and there's also risks around the bond agency itself and how it's set up. There'd be the main barriers to those group issues, but fair play to Lancashire. They said, look, we've invested in this agency, we want an alternative to the PWLB, and we're going to support it and back it, and they've done that in a substantial fashion. But it is telling they've done it on their own, based on their own name. They guarantee the bonds in its entirety, and no one else guarantees those bonds but them. And I think really that's the model that most authorities will be comfortable with, be it in their own small size as well. So it's a way of packaging that up and making it happen. But I think the the mechanism and the guarantees that the bond agency have are generally set up to appease the investor, but still aren't that appealing to the local authority borrower, perhaps. So, yeah, I think they're single name, smaller sizes, a way of packaging it up into an aggregate amount, whereby authorities are just responsible for their own debt. It is the way to go on that.
Great. I mean, moving on to thinking about sort of how authorities should be actually going on about thinking about the process, about how actually they're going to practically do things. I mean, I've chucked a slide up here on sort of a very broad process. Do you want to talk us sort of through what a best practice would look like for an authority that was looking to go for debt, whether it's a big £250 million bond or actually a relatively small £10 million private placement?
Sure, Stephen. And increasingly, it comes down to the project and the strategy. And this debt for yield is going to be very important. It's going to dictate the options available to you and your market pricing of those options to some extent. So, what are the projects? Are you going to qualify for PWLB? Is the sensible starting point, and that is slightly unknown at the moment. We don't know what the rules would be, but I think most authorities will qualify for Public Works Loan Board without too much difficulty going forwards. And we have seen debt for yield projects scrapped, etc. But I don't want to dwell on that too much. And then, of course, what do you need? How much do you need? How long do you need it for? What do you want to pay fixed or floating? Those types of questions need to be examined and answered, and risk appetite will feed into that as well. So I think that's the starting point. And then it's have a look at credit. What's the credit quality and the credit strengths of your local authority, and how are you going to sell that to potential investors? We do financial strength ratings. We're very bullish about the sector, but of course there are clearly plenty of headlines about authorities that are strapped for cash at the moment, struggling for funding, and probably will need some support at some stage. So how does that look to investors, and how does that change your options? Of course, a strong authority, healthy levels of reserves without these pressures on the budget, lower levels of debt, cheaper debt, that's going to be quite appealing to investors. But authorities at the other end of the scale, less so, and that has a pricing implication. And of course, some of these authorities that are really struggling, may find that PWLB is the best option for them, even at 1.8% over gilts. So that sort of feeds into expected ratings and whether you want to go and get a credit rating. And we're quite positive about the merits of that, depending on how much an authority needs to borrow, the size of funding. I think it just broadens your options and gives you the access to the widest range of potential investors, and helps to tighten pricing. So I think it's worth considering for those authorities that have a larger funding requirement. Of course, there is cost, resource, and cost to getting a rating, but it's probably worthwhile for a few to consider that if they want to diversify funding. But of course, I accept that some will say, we'll just wait and see what the PWLB does, and that's been a strategy that has been adopted. But several want to get ahead of that curve, and clearly Lancashire have been able to lever off their rating to get the best pricing. So once you've sort of established those 2 points, then you are into, well, what are my choices? What's going to work best for me? Is it Public Works Loan Board? Shall I rely on local authority funding? Have a look at your exposures there. But I thought a lot of authorities can increase their funding exposure to short-term debt and to rolling over shorter-term debts, particularly given the massive savings available at the moment. Worth thinking about what the bond agency can offer, and bank finance, private placements and loans. The private placement market is a bit fickle, and it's had its own issues with the pandemic, home working, requirements to hold a slightly more liquidity and concerns about the credit strength of local authorities, sovereign rating downgrades have all played into that. But I think investors are pricking up their ears, having a look at the Lancashire bond. Obviously, there was a significant investment there, and we do get a lot of inquiries from potential investors saying, we've got cash, we want to get a return that's above gilts, and we like the credit quality of the sector. So there's opportunities there as well. And of course, the public bond issues and other funding structures, income strips, that type of thing that authorities can look at. So they're all interesting areas, but I think the hedging one is perhaps the most interesting, because we've got quite a particular problem here. We've got an issue where authorities want to borrow and have a funding requirement, and like the level of gilts, which although they've ticked up slightly, are still very low, but they don't like the credit spread that's applied by the Public Works Loan Board, and they've got a very good idea that that's coming down in the future. So how do you manage all those things? And we're working on strategies whereby you separate the two, you separate the underlying movements and you lock into underlying gilt levels, but give yourself flexibility to adapt and to take funding at lower margins if PWLB comes down. So I think that's probably for me the most exciting area at the moment, and the most useful way to look at funding and manage funding, rather than just sitting on your hands and hoping the PWLB come along and deliver something that we're expecting or we're hoping for in a reasonable time frame. So yes, I'm sort of gabbling on a little bit, but you can see that's that's why we're sort of quite bullish and quite excited about what's happening at the moment.
Yeah, to bring 2 points together that you mentioned there, and to look at the previous slide, I totally agree with you. I'm very bullish about the sector. I think the sector's credit quality is excellent when you look at the market as a whole, and also just look at them in absolute terms and look at local authorities and the way they fund themselves and the strength of the balance sheet. But to come back to the expected rating or the financial strength, and also taking it into consideration the previous slide where we were looking at the credit spreads and the spreads of funding costs, do you think that there's going to be a wide range of credit opinions on local authorities, and we'll see some locals funding pretty close to 1.8% and then some locals funding a lot lower? Or do you think actually spreads will be relatively tight and the market will if you're a yes, then there'll be a rate? Or do you think it'll be, well, if you're a yes and actually your rate may depend on X, Y, or Z?
I think it will move, Stephen, is the answer to that, and it's quite wide at the moment. You can see the different funding spreads in the markets. If you look at you look at things like the Aberdeen bonds, which trades a lot wider than Lancashire and the MBA. So there are views on credit. Certainly, we speak to individual investors that will say, "I'm not investing in any authorities that are doing debt for yield. I'm not investing in authorities with these characteristics, be it lower tier authorities for whatever reasons, or authorities that don't meet certain ratios on levels of reserves, etc." So there's a lot of different criteria that play into it. And also there's still quite a lot of unfamiliarity with the sector. Investors don't quite know what a local authority is, what the credit strengths are still, and are getting their heads around the protections that are offered by the government, by the framework they operate in. So we do see a wide spread, and if you're looking at shorter term debt, some of the bank debts, some of those banks seem to be much more relaxed about credit and think, well, most authorities are going to pass. But once you start talking to pension funds on slightly longer debt, beyond 5 years, say, then the credit is very much the word, and there is a range there. And there's other technical points on credit as well. A lot of these funds find it harder or more costly to hold assets that are not rated AA. And while we have local authorities that they will rate internally as AA. If we get a sovereign rating downgrade, which a lot of people think may happen, then it does drop the rating for local authority paper as well. So those sort of things play in, and we've got a few investors that are watching that situation as well. But sort of, yeah, short answer is yes, there will be a spread, but I think that maybe will tighten over time as we work our way through the pandemic and familiarity builds with the sector, and spreads move over time. You know, we've worked on trades and arranged funding in the past at 75 basis points over gilts. When the Public Works Loan Board shift their rates, you know, suddenly those rates are then 160 over gilts, and you know, if we get a reduction back again, then we're going to see those spreads come back in again as well, I'm sure. So that's why I say there's plenty going on, plenty to look at, but also there's opportunity as well. And yeah, thanks for calling up the side on 5. You know, these are the sorts of transactions we have looked at. You know, there are private placement deals. We're also, I mentioned the hedging deals, those deals, top 3 deals in blue that we'll be announcing on shortly, but you know, that's potentially where you're going to get the best savings. But other structures, other bank structures, PFI refinancing, and it's also interesting looking at some of the registered provider investments that we've or funding we've put together in the past. And looking at how some of this can be replicated even in the local to local markets.
I think the registered provider space is very interesting, because I get the feeling that those councils that want to tap the market and do want to diversify their funding streams are going to have to start acting a lot more like registered providers. When we talk to housing associations, etc., they do have to produce a lot of very clear financial information. They have to make it clear how good their internal controls are, and also, of course, you know, do roadshows to make sure that investors really do understand them as an organisation. But I think you're right. There's a lot to learn from the registered provider space, and hopefully we're doing it. I think it's probably time to move on. We've had some quite interesting questions. It's probably time to move on to some questions. So if we start with, we've had a good question from a good practical question that, from Chris Flower. Wouldn't expect anything else. Do we have any indication of when the Public Works Loan Board are likely to respond to the consultation?
No, at the moment we're going on guesswork, and we speak to the Treasury on a regular basis. Clearly, we've got a number of local authorities that will be in contact with key stakeholders as well, but it's mum's the word on this at the moment. And then we think, well, there does seem to be a drive. I think Treasury have said they want to do this sooner rather than later. SIP will want to do it, get it done quickly as well. Local authorities want it done. They want the uncertainty out of the way. They want access to lower cost funding as soon as possible. You know, I think most authorities want to get it done sooner, except those that are sort of doing last minute debt for yield activity who want to get those out of the way. But I think the majority want to get it closed, and you know, indeed that will be a reason why Treasury want to get this new system established as well. But it depends on complex. Sorry, go on, Stephen.
I know, I was going to say, I suppose there might be a little bit of a political dimension to it, in the sense that if local authorities are going to be told to go out and do things by central government post-coronavirus and post-COVID, you'd expect them to want to have the new Public Works Loan Board regime in place by then. So if we look forward to spending reviews and perhaps, you know, autumn statements, etc., it might be not too close after that. You'd hope that it wouldn't be too close after that, considering that it's there's likely to be jobs for local authorities coming out of those things.
Yeah, exactly. So I think that's a key date to look at. We would hope over the next couple of months, but you know, depending on the level of complexity of the new system, it might drag on and be something that has to be implemented at the start of the financial year. There's a lot of form filling that goes on, and categorization of projects, etc. But we're hoping it's a simple system that can be dropped into a financial year. But but who knows? And that's why increasingly we're saying, well, what are these alternatives? And if you've got an alternative that looks like it's going to be better than the Public Works Loan Board, or fairly competitive to Public Works Loan Board post consultation, then progress those and see, row your own boat and see how you get on with some of those, and that they're the opportunities we're pursuing.
Great, and we've also had a question from Peter asking, obviously there's risk involved in the elements of the using the municipal bond agency, where you are in a club and you need to look at the other members of that club. But is there actually a risk from borrowing from the MBA itself? Is there a risk involved in that side of things?
Yes, I say it's sort of an administration and process type setup that I was thinking of in my comments earlier. It's sort of well documented. The bond agency raised significant funding. I think it was £6 million from local authority stakeholders, and most of that has been used up. So they do need to issue bonds. They do need to make a return on those bonds. The spread between the bond issues and the loan to local authority, and the costs and fees to obviously pay for the infrastructure and for that agency to continue. So it's those types of issues, and that's why bond agency, those involved in the bond agency, are continuing marketing and trying to encourage authorities to use that mechanism. That's the point there. But nothing to say that the bond agency can't be a successful alternative to the Public Works Loan Board in some form, but it does, it does have operating costs, and it does need to be supported.
I suppose it's one of those things, isn't it, in the sense that for it to be successful and to be safe as a place to borrow your money from, it needs to be successful, so people need to borrow money from it. It's a frustratingly circular. For it to be an ongoing concern, it needs to make money, as you've very well explained, and but to do that, it needs to issue bonds. So it'll be interesting to see, and I think that most clients, or at least most of my clients, don't have the size of a Lancashire, and therefore are interested in what can we do about club issues. So it'll be interesting to see what comes down the line on that, and if it continues to be able to compete with other options. And obviously, as more options come onto the market, it'll be more and more important to putting words in your mouth, perhaps, David. But it seems to me that from everything you've explained today, that the more and more options we get, the more and more important it gets to really make sure you're analysing those options properly and having a clear strategic view on those options.
Yeah, I think that's right. But in terms of the bond agency, some shorter dated issuance or some access to funding for smaller sizes without requirements to guarantee others that I think that's perhaps where they can be really successful. But we'll wait and see how things evolve, and we'll wait and see what the Public Works Loan Board do. But outside of the bond agency, there's plenty of other alternatives to be having a look at as well.
Great. Well, I think we're coming. I think that's a really good place to draw it to a close. So, before I thank David for being a very interesting guest today, I will thank everybody who's been on the call, and particularly thank you to our questioners. They were both very different questions, but both very useful in their own way. Next week, we will be discussing how we can manage liquidity in a negative rate environment. So do make sure you tune in. If you haven't subscribed to us on a permanent basis, then all you need to do is reply to workshops at Arling Close to get in there. We've finished our summer short series now, so we will be doing things in a more formal manner. Also, do make sure you check us out on social media. We've got a Twitter and LinkedIn presence, and keep checking out the website. We've got a new insight out today by my colleague Stuart, who's talking about strategic funds and managing those. So all that's left to say is thank you very much, David, for being a very interesting guest, and have a nice day.
Thanks, Steve, and you too.